Hey everybody, welcome back to the channel. Today we are reacting to Tom Nash's DCF statement on Palantir. I don't know why I had to look at the sky to just think for a second, but I had to look at the sky. Tom Nash just did a podcast with Justin O, which is his co-host on the Unpopular Opinions podcast. I actually was on that podcast once. I'll leave that in the description. And they were talking with Dave Lee about Tesla, and at the end they started talking about Palantir. Now, some people have been asking me for a valuation, and I've been working on one, but I also think like Tom's valuation is pretty fine. So we're going to react to Tom's evaluation. I'm going to do my own evaluation eventually and show it on YouTube. But I think his evaluation is pretty good because it's very bearish. And with its bear case on Palantir, we're still getting to a valuation for the company that for the stock price right now that is a lot higher than 14, at least 100% higher than $14, or where it's at right now, $14.50. We're at like crazy lows right now. So we're going to react to that. Now, a couple of updates. One, people have been asking where is the part 3 of me and Tom Nash. That is going to be coming out next week. Probably like Tuesday or Wednesday-ish. We are recording part 3 because we did get 650 likes and on part 2, and that was the requirement for part 3. We'll talk about a bunch of stuff. If you have any questions that you want me to ask Tom or any topics you want us to cover, leave them in the comments. We're going to be getting that one done soon, and I don't know what crazy number he's going to make to do part 4. He might make it like 1,000 likes. It's going to be kind of wild because I never got that before, but it'll be a fun podcast. So let's react to this DCF statement. I think it's really interesting. And also the second update, I have an investment banker that is super bearish on Palantir and just kind of growth stocks in general, named Sebastian, and he's going to be on the channel next week as well. So stay tuned for that. That's going to be a fun episode because I want to get different perspectives, right? I don't want to just talk to people who are excited about Palantir. I want to talk to people who are like Wall Street heavy, this stock sucks type of people. So he's going to be on the podcast, and I'm going to get to grill him a little bit, ask him some questions about what he thinks, and I think it'll be fun. So having said that, let's get into Tom's DCF.
DCF to see like what would be the worst case scenario for Palantir, like just assuming the most horrible stuff imaginable to mankind. And Justin can validate what I'm saying here. If it's bullshit, Justin will call me out, because Justin, just so you know, Dave, is like the best DCF guy I know. Sure. So, and this is an oversimplified kind of executive summary of a DCF. That's just the bottom lines of everything. So we don't have time. So I basically did. So they'll do 1.5 trillion, 1.5 billion in 2020.
Yo, if Palantir did 1.5 trillion in revenue, bro. 1.5. Has a company ever done 1.5 trillion? Yo, leave it in the comments. What company do you think that exists currently or that would have to be created one day to do 1.5 T in rev? I'm trying to think. I feel like, to be honest, my guess right off the top of my head, it would be Tesla. And the reason it would be Tesla would not only be the cars, they would have to supply the world's energy. And then the Tesla robot thing would have to transform the world's industry, like like in all the factories that exist in the world. So the industrialization of that robot being everywhere, and supplying the world's energy and selling a car with like a 30% gross margin, they could pull in 1.5 trillion of revenue. It's not crazy for me to think. But yeah, that would be good. Leave it in the comments what you could think.
21. I wish they would have done that. So 1.5 billion in 2021. And then I just did like a super straight line, 30% as per guidance. 30%, nothing exponential.
When he says that, that means there's revenue 1.8 billion in 2022, 2.4 billion. That means every single year he's calculating 30% revenue off of the 1.5 billion they're going to do in 2021 per their guidance, which means they're growing till 2027 at about to $6.9 billion in top line revenue.
Like nothing, like I would nothing parabolic, let's say, right? So constant 5-year, 30%, business as usual kind of growth, which is strong but not explosive. Kept pretty much cost of goods at about 20%. Gave an annual boost to the SG&A, I think 20% every year or something like that, and increased R&D expenses every year as well. Added in 21% tax, even though they have a lot of NOLs that they're going to carry forward from past years where they had losses.
So what Tom's saying here is the corporate tax rate right now is 21%. thanks to Trump. I don't know if that's going up anytime soon. We'll have a new administration in 2024. So if it's a Republican administration, that's probably not going to happen. If it's a Democrat administration, seems like it's probably not going to happen, because if Joe Biden wanted to raise taxes by now, or the Democrats, I feel like they would have done it by now, right? So because they haven't done it, I think they know that they just don't have any chance to be able to like get that through the Senate. So that's probably not going to happen. So that's a pretty decent estimate. But there's two things about here that's important. Number one, this is before all the loopholes, right? So companies don't actually pay 21% in taxes. Like there's so many things that they deduct just in terms of losses. I know this because I own a business and I have expenses, right? So I write off my expenses. So, oh, I took this Uber over here. That's $15 that I had to spend. That was a business expense. So I deduct $15, right? So Palantir is going to have tons of expenses that they're going to hit against that 21%, and they're going to use all their loopholes. So it's probably not going to be 21%. So he's being very conservative here. He's being conservative on two parts already. 30% growth year after year, excluding any potential of there being like 40% one year, 45% one year. And we're expecting, right, as shareholders for a high growth tech company, that'll be more than 30% at least one of the years, if not all of the years. For them to really go crazy, right? So 30% every year, top line revenue, and then tax rate 21% without doing any of the loopholes. And then on top of that, Palantir has had losses in previous years. And when you have a business, you are able to offset your losses against your taxes. This is the whole concept of tax harvesting in the stock market. So I actually know someone who owns a lot of shares in Palantir, and they sold them all in 2021 at the end of December to offset those losses, because now let's say you lost 100 grand in Palantir, but you made 200 grand in income. Well, you would have to pay taxes on that 200 grand, but if you lost 100 grand in the stock market, that goes against your income. So now you only have to pay taxes on 100 grand because you technically lost 100 grand, right? So Palantir has had years of losses as a high growth tech startup when they were in that startup phase, and they haven't applied that to their future taxes. So there is going to be a lot of losses, just like Amazon did for a very long time. They were losing a lot of money. So that's why Amazon didn't pay federal income tax for so long, because they were losing so much money in the first years of becoming a business that they always just carried those losses on to every tax cycle for the next year. That's likely going to happen with Palantir as well, but Tom's not accounting for that, right? So even at that level, the tax rate of 21% is super conservative based upon the stuff I just talked about, and he's deducting that 21% tax rate from all of the earnings that they get.
So they're not going to pay tax for the next 3 or 4 years anyways, but I did like a 21% nominal, no deductions, no nothing, like a straight 21% tax on every single dollar from now on, which is bullshit. And I assume 200 million in capex investments in the next 5 years. And I assume a 10% discount rate for the model. So Justin, can you verify that this is quite a conservative model, or at least somewhat conservative?
I mean, I would have to see the revenue numbers, but yeah, like at a certain
Justin's like, I want to say yes, but I'm like, and Tom's like, all right, bro, whatever.
1.5 is
gut checks, right? So
yeah. So 1.5 is 2021. So you can see the growth of the. Anyways, so then 4% perpetual growth, blah blah blah. Never mind. And what I did, so these are my values. So usually that would stop here, 44 billion, 0.14.
That's referring to the market cap. So right now, Palantir is at like a 30 billion market cap. My phone is charging, so it's over there. But yeah, at $14.52, like around 30 billion, maybe a little bit under that. So he's estimating it's a 44 billion, which would be a little bit like a doubling of the stock price, right?
So that's kind of the bear case value of Palantir today. And what I also do for my system, Justin doesn't do that. I combine it with the multiple calculation, and I do like an EBITDA multiple. So for a tech company, usually you put 25, but I just did 18 just to fuck with the valuation. So I did like an 18 multiple on them, even though they deserve 25. And so I have 55 billion for multiple system and 44 billion for the DCF system. So basically, as it stands now, they're pretty much a $50 billion company based on my own analysis. So
Tom, I can say you're being super conservative on the terminal value, because companies don't, as we'll see with Tesla, as we saw with Apple, as we see with Google, class teaches us 4%,
4%, inflation.
It doesn't go to 30% to 4,
But I just wanted to say to myself, well, Tom, if you're buying now for 15, 16, 17, 18, I mean, what's the so for me, even if I look at, unless there's a catastrophic failure, like a Theranos, Enron, or a governmental change that changes the way they regulate, unless something completely screws with their business, or their business is fake, which I don't think so, since for 17 years people would not have been paying for vaporware. So unless something bad, like catastrophically changes the way they do business, it's a $50 billion company right now today with no B2C business, no medium-sized B2B business, just large governmental and large like Fortune 500 company clients. That's it. So like for me, it's such an easy deal to buy more.
Yeah. I mean, one feedback is on the R&D.
So, but before we get into Dave Lee's thoughts on the R&D stuff, which was also interesting, yeah, I mean, Tom's making a pretty good point. So you saw his DCF statement. It has the most bearish assumptions you could logically put into it, right? And it's not trying to be like, you're not trying to like act as if it's bearish and be fake about it being bearish. Like the taxes, pretty bearish on that, right? That they're going to pay actually 21% and they're actually not going to offset some of their losses. The growth rate, 30% just in terms of their guidance. We're doing exactly what they said, but we are all expecting it to be more than 30%, because if it's not more than 30%, I'm going to be disappointed as well, given the potential of the growth of the company, right? Like you want to see it ultimately grow at a much higher level. And then on top of that, the 18x versus 25x multiple. Most technology companies get a 25x multiple, and he gave it an 18x. And on top of the 4x multiple on the other one. So it's like, it's important to recognize that, and that's why even Justin was agreeing with him for some extent, because something like a Tesla, right, which is what people say Palantir is like the Tesla of data, they just get way more from the market in terms of their multiples, and Tom is being super conservative on that in this DCF statement. So it logically makes sense to understand why it would be like that. Now, a lot of people say Palantir is overvalued because of a ton of the stock-based compensation and a ton of the outstanding shares. So it's like, and then you're giving multiples on a company that isn't really necessarily net profitable yet. So like that's where the overvalue type of like statement comes in, along with the fact that 60% of the revenue is the government. So all of it's just concentrated in one place. So that's like the trifecta of the bear argument for why it's overvalued. But if you really do the math and the numbers and you just project what management is saying they're going to do and then put on sprinkles of bearish sentiment all across the DCF statement, it seems logical that it's a $50 billion company. And it's and to Tom's point, this is without a B2C product. This is without attacking mid-sized, medium businesses. They have Foundry for builders, but like that's not really like a subscription-based service at the level of hundreds of thousands of dollars per month to like medium mom and pop stores. And when I mean mom and pop, I mean companies that are not doing hundreds of billions of dollars in revenue. This is only assuming they're going to keep working with commercial clients. And we all know in the next 2-3 years, they're literally building every part of their business, like Foundry for crypto, to not only work with the only Fortune 50 companies of the world, to work with literally Fortune 1000 companies and just like generate the entire world's revenue through their infrastructure of offering data analytics services. So it's a decently bearish DCF statement.
Like there's potential for Palantir to be much, much higher in terms of R&D spend. They like to spend a lot, so I don't know. We'll see though.
How much did I put of R&D? So I think I put for the next 5 years for R&D, I put...
I think you have it doubling in like 3 or 4 years or something.
Yeah, it could 397.
I think.
Yeah, 400 million 2022, and then 640 million in 2027. So
yeah, actually, you have it less than doubling in 5 years. I don't know. I think there's.
I'm just curious to see what happens if we do 50% per year increase in R&D. Just to see what happens to the valuation.
Yeah.
If you do a 50% increase in that would be cool to see what we get. If we do a 50% increase in R&D and we have 3 billion R&D expenses in 2027, they're just priced right now at 25 billion.
So basically, so Dave brings up a good point. He's like, all right, well, they spend a lot of R&D because like they invest a lot in their company and they do a lot of AI stuff, so they have to do research and all that stuff. So Tom's like, all right, let's grow them 50% R&D year. Like they're growing as a company, so they're going to do 50% R&D year every single year from now until 2027. That means they're spending $3 billion in 2027 on R&D. That's ridiculous. Like that's not for a software company to spend that's probably not going to happen. So if that were the case, then how they're priced right now is perfectly fine at 25 billion of market cap. Like this stock price that we're at right now makes a lot of sense. But you're not adding $3 billion of R&D. Like that's just, they're not making a car, right? Like at the end of the day, they're making a software and then they're just like licensing out that software. So the product and the margins on that product are phenomenal. I think it's like 77% gross margins right now. So like you don't really need it to invest that much in R&D. Another good point is if they were only making $6 billion in revenue in 2027, as per the DCF statement with 30% year-over-year growth, and doing $3 billion in R&D, the company's bankrupt. Like, you can't have half of your revenue going to R&D. That makes no sense, right? So it's very unlikely that the R&D is going to be a big concern, but it's a good point that Dave Lee brings up. So, at that point, you kind of got to think, all right, is Palantir a $50 billion company right now? And is the market and what's happening in the macroeconomics just totally undervaluing it for good reason, because it's undervaluing everything? There's quantitative tightening, interest rates, blah, 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 whatever. Then you start to realize, well, Kathy's loading up, and you could think about Kathy whatever you want, but like, she's got, a decent 25 million shares of Palantir, or I think 34 million shares of Palantir. So it's like, all right, maybe it is a little bit undervalued, and if it is undervalued, then the question is, when is the time to load? It's hard to time the market. So you gotta kind of just make the decision and keep doing what you got to do. For some updates on me, I'm going to do another video at the end of January showing all the buys I've made at Palantir, because I know people have been curious about that. I've been buying this dip. I think I've spent about $2,500 in the past couple weeks just buying more of the dip. And to some people that's a lot, to some people that's not a lot. For me, that's a decent amount of money. Just buy it in little increments and get it at 14, get it at 15, blah, 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 blah. Not financial advice. This is just what I've been doing on my personal portfolio, because I believe in the company, and I believe that putting money in right now, this is like when articles came out, when you see Palantir go to $5, there's articles of Tesla going to $10 in 2019. That was 2019. In 2020, they were at $900 before the split, right? So, it's really interesting to think of that stuff and sort of do your own evaluations of it. So it'll be an interesting ride. We'll see what happens. Let me know your guys' thoughts in the comments. Let me know what you think of Tom's DCF statement. Looking forward to reading them. My name is Mitt. I'll see you guys in the next one.